This episode of the Martini Factor, I cannot guarantee is going to be entertaining, but I can promise you it will be informative. Hello, this is Kevin Martini with the Martini Mortgage Group at Benchmark Mortgage, which is located in Raleigh, North Carolina, and this is episode 6 of the Martini Factor. I will be sharing my understanding of the Tax Cuts and Jobs Act. Now, as a disclaimer, I am not a CPA, nor am I a tax attorney. I am a trusted mortgage planner that works very hard to help my clients create wealth, and I feel it is my duty to keep my clients informed. Now, with all that said, how can the Tax Cuts and Jobs Act affect you? You see, you can still deduct mortgage interest under the new plan. The deduction is limited to $750,000 of indebtedness starting in the 2018 tax year. Now, if your mortgage was issued before December 15, 2017, you will be able to deduct mortgage interest up to $1 million of the mortgage-related indebtedness. Wow. Mortgage-related indebtedness is a mouthful, and it has real meaning in the Tax Cuts and Jobs Act. By definition, it means money borrowed against property. In other words, money used on loans using property as collateral. Why is this so important? Here is the Kevin Martini breakdown. You see, the Tax Cut and Jobs Act will eliminate the way many homeowners use home equity lines of credit. Now, interest paid on home equity lines of credit that aren't considered home acquisition debt, also known as mortgage-related indebtedness, will no longer be tax deductible. I know what you are saying right now. You're saying this, Kevin Martini, why didn't you tell me this before so I could have maxed out my home equity line of credit? Well, quite simply, the reason I did not share it is because there is no grandfather provision for this rule. If the balance on your home equity line of credit is not mortgage-related indebtedness, then it is not tax deductible under the Tax Cuts and Jobs Act. Now, don't panic. Here is the Martini Factor talking point. If I or anyone at the Martini Mortgage Group with Benchmark Mortgage structured a piggyback second for you, then as long as you stay within the total mortgage interest deduction cap of $750,000, that interest should be deductible. With the current epic mortgage rates, it may be a worthy discussion to roll an existing lien into a new first mortgage. We could do the math together, and if it makes sense, we'll do it. Just give me a call. My name again is Kevin Martini at 919-238-4934. To take advantage of the mortgage interest deduction, you will have to itemize your federal taxes. Now, some homeowners may find it worthwhile to itemize to claim their deductions, and others may not because, you see, the standard deduction will nearly double to $12,000 for an individual and $24,000 for married individuals who file joint returns in 2018 tax year. I know, listening to me talk about tax stuff can be miserable, and I'm sorry about that. However, I truly thought this was information you should know at a high level. Episode 6 of the Martini Factor may bring some questions to your mind, and if so, I invite you to give me a call at 919-238-4934 so we can have a confidential conversation about your situation. My name is Kevin Martini with the Martini Mortgage Group at Benchmark Mortgage, located in Raleigh, North Carolina. And if you want or know someone that needs trusted mortgage advice that is educationally based in a stress-free environment with great home loan rates and on-time closings, I am here. Thank you for watching episode 6 of the Martini Factor. And please share this with somebody that you know that might benefit.